our dear panelists, Hallie. Can you join us, please? Haley, sorry. My accent is not correct. There you go. Correct pronunciation is Haley, right? Haley, sorry. Sorry. Katrina, please join us. Thank you so much. Dear Sophie, please join us on the panel stage. There you go. Guys, this mic. Okay. Well, the main question of this panel is how female founders raise capital. Before we start, why do we need money? Why do you need capital? That's the question. And to spend. That's exactly it. The question is, you have to explain how you're going to spend it to get it. Depending on how you're going to spend it, you will either get it or not. So you need to convince the investors that you want to spend it well. How do you define well? That's what we're going to talk about. So how do you spend and how should you spend it, where to spend it, and how to convince those that have the money to give it to you, to trust you, as Mirella was saying. So let's start there. There's Sophie.
I see. Understood. So how do you build trust? First of all, it's really about understanding what is someone else looking to invest in, what is their risk profile, what geographies do they like, what returns are they looking at, how much capital are they prepared to risk, or are they high or low risk. So it's really understanding who is your investor, what is their appetite, and then approaching them with appropriate deals for that. But in terms of relationships and trust, it's just like any other relationship. It's consistency. It's saying what you're going to do and doing what you said you were going to do. If something happens that was unforeseen, whether it's good or bad, communicate, over-communicate. And physicality is really important. So we talked about being global. I mean, I live with Singapore, Dubai, London. I'm in the US quite a lot. And you need to be in front of people because, yes, it's absolutely important. We can do a lot on videos, but you have to be in person, looking across people eye to eye, having a coffee, having food together. And that is the way that you really, really build trust and relationships, and means that you can do things on the phone, on video, but only when you've built that trust in the first place.
You know, when I speak with founders who are asking for capital and raising money, words are a dime a dozen. I could ask questions, you could tell me the answers, but I like looking at micro signals. It's hard to fake body language or things like that, you know. And in terms of building trust, because there is no established trust if we meet each other for the first time. But I want to know, who are the people who are going to vouch for you? Who are the people you've worked with? Were you a co-founder with someone else before? Did something fall apart? Did you raise money in the past? Where did the money go? So I want to look at track record. Although past history is not indicative of future performance, I want to be able to see how you're able to spend other people's capital, whether that's your mom's money, you've bootstrapped your startup, have you borrowed money from other people, for instance? Because it's very telling the way people spend money. Their money or other people's money. And I don't believe that money changes people. It just magnifies who you are, you know. And so I've formulated this group of questionnaires that I asked founders on a first meeting. They might sound very casual questions or like getting to know you questions, but those are questions designed to kind of bring out certain character traits as well. Like one question may look different from the other question, but they mean the same. It's just, for example, it's a question of your resourcefulness. It's a question of you said no to the other question but said yes to the other question. It's an integrity issue as well. So if you want to be able to build trust, it has to be always consistent. Because like what Mirella said a while ago, it's not important who you know. You could name drop 1,000 people, but who know you and who will vouch for you in rooms where you're not always there. So trust, and I said the micro signals. You could say a lot of things, but there are some subtle signs, and we're able to validate and revalidate that, okay, she said no to this. I'm going to ask this in a different form. And I look at like the blink of your eye, the position of your foot, you know, your tone of voice. Those micro signals, they're pretty hard to fake. You know, simple questions are very telling sometimes. So I like to look at those things. Thank you.
Superb answer, actually. And I'm an angel on the Sky TV show Property Elevator, and that's kind of like the Dragon's Den for property investors and developers, where people will stand and pitch for funding for their deals. And the biggest mistake that people make that are trying to raise capital is faking it before they make it, actually making out that they've done a lot more than they have, or they know something that they really don't. And one of the things that I see most people fail on is when we come back and we ask questions and it becomes apparent that actually you don't know what you're doing, or you've overinflated the value that you bring to the table. Actually, then I'm questioning everything about your deal. So trust is the most important thing where capital is involved. And I always invest in the person first.
Yeah. Just one thing to add about the name dropping. People will reference. And I've had a situation when someone name dropped somebody. And so I rang them. And they're like, yeah, I met them once because I interviewed them. You know, you need to be super careful and know that everything will be followed up.
Brilliant. Oh, you want to follow up?
It's important to show up as your best self and just be honest about where you are. And actually, you know, money isn't the only currency. So be honest about where you're starting at. Don't fake it before you make it. And I think that's the most important thing, because I've invested in people that have never done a project before, but they've put a really creative deal together, and actually they are good, solid people. I trust them, I know them, I like them, and often on the show, and the same with Dragon's Den as well, the deals don't always come to they actually don't happen, but we do end up having a relationship with those people and investing in deals that are not actually part of the show. So it's all about relationships.
People do the faking until you make it. That's a concept in business. It works for the end customer, because if somebody's going to buy a product that you have, they need to believe and buy the product. But if you do that with investors, you're breaking the trust element. It's a completely different world to raise capital or get a customer. Brilliantly said. That is absolutely amazing interventions. So let's go into the next level. So you trust somebody. Now you get a bound. When does it make sense to bring capital to the table? How do you know that you need capital? Sometimes you don't. When it's the right moment to address investors? What is the role of an investor?
So there's different reasons why people might want to bring an investor in, but a lot of the time it is driven by cash. So what are your cash requirements? Back to what Ray was talking about earlier today. You know, what is your cash flow forecast and what do you need that money for? And at the end of the day, it's what you said. It's like the sources of cash and the uses of the cash. So that is the main driver why people bring in an investor in, and it's up to you whether you can bootstrap it and do it for yourself to get it to a certain size, and then the business will be worth more and you're bringing in capital when you've got a high valuation, or do you need it earlier on? And it really is depending on what sector you're in. So Haley and I do a lot in real estate, and a lot of the ticket prices, the purchases are quite significant, even if you put debt in them, and therefore you often need to bring someone in just to buy the building, buy the land, do the development. But there are other businesses, particularly service businesses, where you can actually manage by yourself for quite a lot longer. So there isn't a right answer, but it is often driven by cash.
When I invest in startups, out of the 35 startups I invested in, the channel by which you want me to invest matters a lot. Is it going to be equity? Will I get shares from your company? Will it be through debt? Is it like a straightaway loan? Will it be a safe note? Safe note is usually done when you don't know the value of your company yet because you're new. You don't know how to compete for valuations, but okay, we're going to invest X amount now and we're going to compete valuations later on. Or is it going to be convertible notes? All of these instruments, it matters to me as an investor because at the start of any startup, if you're raising capital, we are bearing the risk. We know that we may or may not get our money back. So if your startup is very high risk, for example, it's just like idea phase, I would not want to invest straight away equity, for instance. I would tell you, okay, I'm giving you this as a convertible note, meaning we start as a loan. If your company gets bigger someday, I'll convert it to shares. But until your company's X amount in valuation or you're able to complete these milestones, this is going to be debt. You owe me. So, but if the startup, for example, has a lot of potential in it, there's traction, there's you've already raised capital from other reputable angels. It matters so much to me who were your first investors. Were your parents, your professors, who were the first people who trusted you? And when I see that there are high caliber people, professors or other doctors who have put in their vote of confidence through funding, I'm more comfortable coming in equity. But you also have to be careful because you have a lot of predatory investors. They know that you need money, and they would give you counter offers. Okay, I'm going to give you X amount, $1 million or £1 million or €1 million for 10% of the company. And because you need the money, you're just going to say yes. So not because you're raising the capital doesn't mean you're always on the negotiating part. You also have to vet your investors. Because if all that your investors could give you is money, then it might not be a good alignment. I do not like investing in companies where the only thing I could give is money. I want to look at companies where I could help them scale and grow and connect them to other ecosystems because some investors are so poor, all they have is money. So yeah.
I love that, actually. I'm going to steal that line from you next time you see me on TV. So I completely agree. And actually, in the UK, I get a lot of people that come to me for my experience because they want to leverage that. And also lending in the UK is very different as well. So if you're looking to get into ground up development or large commercial projects, as a new person coming into the industry, you wouldn't have lending off the back of that from a conventional lender or specialist lender. So quite often people will come to me with some capital, but actually they want to leverage the experience that I have so that we can go down a joint venture route and I can add value to their journey. They can learn along the way. But I'm okay with people just wanting my money as well. As long as you grow that and I can see that there's security there and, I trust you and what you say backs up and you have good solid information to prove that, I'm quite happy to either mentor, grow the business with you, continue that relationship, or you grow my money and give it me back.
When you look into a founder, so the question of the panel is how female founders raise capital. Share a little bit your vision on, when you decide to invest, what motivated you to invest, right? You did address a little bit of it on the previous questions. When you look into a founder, why do you invest? What is the trigger? Is there a trigger? There's no right answer, but what do you see there that makes sense for deploying the capital?
So for me, when I started out, I'm from a council estate. I'm one of 7, broken family. We were very, very poor. And I just wanted to create something that was better for me and my family. I was always happy. I was happy with that money. I'm happy now with it. If I lost it tomorrow, I would get it back within 12 months. It's about what we know and how we apply that and the action that we take. What was the question? Sorry. Menopause brain.
It's great. You're doing great. The question was, when you look into a founder.
Yes. Yeah.
Why did you decide?
So for me, it's about resonating with the individual, understanding where they're coming from, the passion, and their why behind why they want to do this. It's not often about money. Money is the vehicle, and actually there's something else that sits behind that.
I like to, when I talk to founders, aside from, of course, the basic, the character thing about them, I want to be able to ask them, like, I look at, to be able to know if they're going to be successful, I look at talent density. Meaning, talent is important, but are you going to be able to hire people smarter than the founding team? Will you be able to attract talent? Because talent is not enough. The most successful startups I've seen that became a unicorn, they were surrounded by massive talent. They were able to attract people smarter than them. And I have a very huge bias for speed. I want people who execute relentlessly. Begin before you're ready, and just, because the more you execute, the more you're able to test and fail forward and test again. And so I have a bias for speed. I like founders who execute well and execute relentlessly. And last, that I really look for, I want hungry. I want very hungry founders. Like, okay, if you're not going to raise a single dollar this year, what will it take you to raise that capital? Like the founders of Airbnb, they had to sell cereal boxes. And now they're a multi-billion-dollar company, but if they did not sell cereal boxes before, nobody believed in what they had. So that was a measure of their creativity. So the non-tangibles are very important, and it's very important for me to be able to realize as well how attractive they can be to other investors. And like what I said, are you able to hire people smarter than you? Are you able to attract that level of pedigree around you? Because that's very important. The best startups are able to attract the best people as well.
And then it might sound obvious, but a good business plan. You need to have a good business plan that makes sense. And I'd be concerned if I looked at a plan that didn't make sense. I'd really want to understand why that person had put that together and put that in front of me. And sometimes you can talk through that and work through it. But you do need a very good business plan. And also when you're putting in the money, you need to be happy how it's going to be spent and also have controls and processes over that. So you would never look to put that money in straight away. You'd look to have certain milestones that need to be hit in order to put the rest of the money in.
Ladies, wonderful panel. Thank you so much. That was fantastic. It was a pleasure to be here. Looking forward for the rest of the event. Thank you so much. Thank you, my dears. Thank you.